Spicer made a comment saying the president is in favor of negotiating pharma prices, and you saw that big move down and a little bit of a comeback, but the sector still remains down 0.4%.
All right, let's take a look at the government bond market, starting with the U.S. 2-year and the 10-year. Not a whole lot of action ultimately. The U.S. 10-year was off its lows, though it did end down, or it did end at 2.4%. Not a whole lot of action there ultimately, however. And Greece, though. I mean, we were talking about Greece yesterday. Continued impasses on the bailout. 2-year yields really shooting higher again. They've been on a real tear lately, getting close to 10%, which would certainly grab a lot of headlines. That bailout in limbo. And then here's a longer-term chart of 10-year yields, which we were just talking about a little bit before the break. This is a 1-year chart. You can see that big shoot up in November, and then it got as high as around 2.6%. But since then, we've not only stalled, but we've actually pulled back. And they just really haven't done much of anything. In fact, yields are slightly down, I believe, for the year. A lot of people thought they were going to go higher. So it just sort of stalled out here. Yeah.
Stuck in a range.
Stuck in a range.
Now, in currencies, if yesterday was a display of yen strength, today is more about dollar recovery. The dollar is tracking the swings in Treasury yields. You had Philly Fed President Patrick Harker echoing John Williams, the San Francisco Fed President, and signaling don't count out a March rate increase. In other words, March is a live meeting. It is on the table. So you can see there a recovery there for the dollar. Also, I wanted to highlight the British pound. It erased its losses after a Bank of England official says he sees the risk of faster than expected inflation and said the UK may need a rate increase soon as well. So there's that dramatic move up at about 9:10 a.m. our time. Now, commodity currencies from the loonie to the krone are under pressure. The weaker oil is certainly a drag there. But for the loonie in particular, Canadian trade numbers also came out. And Vince Signorella of Bloomberg First Word was saying the headline figure showed a larger surplus than forecast, but the underlying data was not as encouraging. Exports, for instance, fell 1.4% month over month.
And finally, on the commodities front, Scarlett was just talking about those commodity currencies, and you can see it right there. Crude continues to slide. I mean, it's roughly in the same range it's been for a while now, really tight range, down 1.5%. And gold, which has been bouncing back a little bit, up another 0.2% there. Not a ton of action today on the commodities front.
All right, and that is today's Market Minutes. And we have some results, right?
We have some breaking results from Gilead, which is out with earnings. The pharmaceutical company reporting Q4 adjusted EPS of $2.70. That is a beat. Estimates had been for $2.61. The company, Gilead Sciences, says it's going to boost its dividend by 10% in Q1 2017. Revenue $7.3 billion versus estimates of $7.16 billion. So it looks like beat on the top line and the bottom line, but the stock is trading down a bit in after hours. So we'll continue to monitor that to figure out why markets aren't thrilled. But on the main headlines, coming in a bit ahead of expectations.
All right, and let's take a look at Mondelez as well. Fourth quarter net revenue missing the lowest estimate of the analysts that we surveyed, and adjusted earnings per share of 47 cents. Analysts were looking for 49 cents, so 2 cents shy of what analysts were anticipating, though the company does reaffirm its forecast for 2018 adjusted operating income. So the stock not moving a whole lot, currently down 0.5% in after-hours trade. Now, one of today's losers is Motorola. The stock shed as much as 6%, its worst day since November of 2015, and it is largely due to one analyst report. Noted short seller Andrew Left, whose work previously shone a light on Valiant's weaknesses and shady business practices, well, he released a report predicting huge losses for Motorola Solutions. He writes, through either government scrutiny or just evolution of technology, Motorola's gross margins on its U.S. handset business will be cut in half or more in the coming years. It appears that no lobbying, high-paid consultants, football tickets, golf outings, or Las Vegas conferences can overcome the forces driving competition and innovation. And we should mention as well that Motorola did come out with a statement saying that CITRON has made numerous false and misleading statements. Motorola mentioned as well that, of note, CITRON's comparisons to products and price points in Europe and other locations are baseless, as different countries have different standards and require different technologies. Let's bring in now Andrew Left. He is founder, owner, and editor of CITRON Research. He joins us by phone to elaborate on his call. Andrew, you priced Motorola Solutions stock at $45. Right now, it's above $70. Talk about Motorola's weaknesses. Are they that profound that we're going to see that kind of drop?
Well, the amazing thing about Motorola is the bulk of their profits through all their business channels comes through selling actual handsets to the U.S. law enforcement industry. And those handsets, if you see the report, are coming in averaging over $5,000. And you could buy the exact similar product in the UK for $700 or $800. So if you strip that out and you say, okay, if President Trump says, now let's go negotiate, let's go look where the government's spending money, this is a complete waste of money. Because not only are they spending more money on them, you could be argued it's an actual inferior product to what's being sold to other law enforcement agencies worldwide.
All right, Andrew, just hold on 1 second. I need to interrupt because Disney has reported results. First quarter adjusted earnings per share of $1.55. The consensus estimate was $1.49. If you look at revenue, however, for the fiscal first quarter, that missed the consensus estimate, $14.8 billion. Analysts were looking for more than $15 billion, $15.3 billion to be exact, and the stock is down 2% in after-hours trade.
And cable networks operating profit $864 million versus estimates of $1.08 billion. So that looks like a substantial miss on this front. Monitor Disney earnings, will have a lot more of that.
All right, and also with Disney, as we mentioned, the revenue number is one that's of great concern, especially because Disney fires from all these different cylinders, right? You mentioned cable networks. The theme park is also another area of huge profitability, but of course it had the Shanghai park to contend with, and there are a lot of cost overruns there.
Right. Total revenue Q1 $14.8 billion. Estimates had been for $15.3 billion, so quite a substantial miss on the revenue front for Disney.
And again, when you look at the stock, it is trading lower by 2%. We're going to look for some intelligence on Disney from CEO Bob Iger when he speaks on the conference call. A lot of questions there, Joe, on what happens with a succession plan there, because he's already had to extend his contract a couple of times because they haven't found the right person to take his place once he decides to leave.
Yeah, it should be a lot of big questions on the call.
All right, Andrew left us Citron Research. Stick with us here. We just want to go back to the Disney report here and bring in Paul Sweeney of Bloomberg Intelligence. Paul, when you look through the numbers, first blush, what's your impression?
Yeah, it's very much a mixed bag coming out of Disney, and I think we're seeing that a little bit in the stock pulling back. You know, the revenue miss is a little bit of a concern here because we knew this was going to be a tough expense quarter for them, in particular on the cable network side on ESPN. This was the first quarter they were going to have to deal with the NBA contract, which is $600 million of incremental expense. So the company had certainly guided down for that. But on the revenue line, this is going to be something that the management's clearly going to have to address across their business lines, the revenue miss. So again, those are the issues. I think if you kind of rank the concerns for investors, it really starts with ESPN and the cable networks, and really kind of how the outlook looks there, particularly from the subscriber perspective. Are they still losing subscribers? If so, to what degree? And if they are, you know, what really is the competitive response for ESPN?
Well, they have said that they're launching a streaming service that's separate from ESPN on television, right? That's subscription only. That should kind of dent or bring back some of the customers, right?
Yeah, the real issue with ESPN, unlike some of the other cable networks that have decided to go direct to consumer with the streaming services, what content will ESPN put on the streaming service? Is it going to be Australian rules football, or is it going to be the NFL and the NBA and things like that? So that really remains to be seen, because the real issue for ESPN is they've shelled out billions of dollars for rights fees to, global rights for these huge sports, the NFL, Major League Baseball, NBA, and they really need to keep those rights within their big pay TV bundle, because that's where the revenue is generated from affiliate fees. So they walk a very fine line, but clearly the street is going to be looking for more disclosure from the ESPN and the Disney folks.
And just a quick correction here from Bloomberg. Disney's first quarter cable networks operating profit, $864 million. The consensus estimate was for $1.08 billion. Cable networks, Paul, of course, includes ESPN, right?
Right. It does not include the ABC broadcast network. So, but that's really the business I think people are really going to be focusing on. So, again, the operating profit miss, even with the higher expenses, people are going to want to get a handle about where that came from, because we knew about the NBA expenses. What else was in that number?
All right, Paul Sweeney of Bloomberg Intelligence, you'll be staying with us for more on Disney first quarter earnings next. This is Bloomberg.
What'd you miss? Disney reporting results missing on the top line on revenue for the fiscal first quarter. Joining us for more analysis is Chris Palmieri, Bloomberg's media reporter in Los Angeles. And still with us is Paul Sweeney, Bloomberg Intelligence Director of North American Research. Chris, let me start with you. We fixate here on the cable network's revenue and a drop in the operating income in that business by 11%. And this, according to the company, was all due to a decrease at ESPN. How big of a theme is ESPN going to be in the conference call today?
I think that's going to be the headline for a lot of investors. It was a big miss for ESPN. They've signaled they've been having problems, subscriber losses, $600 million increase in the NBA rights fees, but still this was a big drop.
The stock really isn't down that much. We're talking about the miss, but we're not seeing that big of an investor reaction. Does this suggest that Disney has been doing a pretty good job telegraphing what kind of issues that it's been that it's having with its core businesses that investors aren't particularly surprised at this point?
That they have been telegraphing it for almost a year and a half now. They've been saying, ESPN is an issue. We're aware of it. We're trying to get in the new lower-cost TV packages. We made a big investment in online Major League Baseball's online arm, and they're going to launch an online version of ESPN this year. So they've been talking a lot about this. They've been guiding that there could be disappointments. It's still a huge focus for everyone.
Paul Sweeney, ESPN was a crown jewel for Disney. We've been saying that for so long. It was also super consistent for the company, the biggest profit generator. What other parts of the business does Disney have that can make up for that?
Yeah, the two big areas that they've been leaning on, I think they will continue to lean on because they continue to invest in them, is their theme park business. They just invested $5.5 billion in Shanghai. They're building cruise ships as fast as they can put them in the water, which are all good business for them and are driving the good results from the theme parks and resorts business. And also the theatrical business, the film business, has been just an incredible, consistent profit generator, unlike any other studio, which really has to deal with the hits and misses of making movies. For Disney, it's been almost a straight linear line up and to the right with the operating profit from their film business because they laid the groundwork probably 5 to 10 years ago when they bought for billions of dollars Pixar and Marvel and Lucasfilms. They are starting to really reap the benefits of those investments right now. So those two businesses are offsetting what has been a surprisingly, I think, greater than expected decline in the core cable network business, particularly at ESPN.
So yeah, let's look some of those numbers. Parks and resorts revenue $4.56 billion, a little bit shy of estimates at $4.69 billion. Also, studio entertainment revenue also just shy of estimates at $2.52 billion. But your point is, they might have a little bit of a miss here, but the real story is that these are just straight lines up and to the right, very unvolatile sources of cash.
Yeah, the one that's really surprising investors, and I think the investors really haven't gotten a handle about how to put a proper value on, is on the studio. Again, most of these studios for these big media companies generally have not been valued very highly because the cash flows are so volatile, and they tend to be lower margin businesses in general. But Disney, again, because they put that capital up front to work and were able to buy these world-class brands, they've been able to generate very steady profits coming out of that business. But, the company said fiscal 17 is going to be a tough year for them for a number of reasons, one of which is they're only releasing 7 films this year versus a typical year of about 11 films. So they're trying to get everybody to look past fiscal 17 and look into fiscal 18, where they're going to be back to 11 films, where the tough NBA comparisons from a cost perspective will be past them. And that's when, if you look at the street numbers, there's a re-acceleration of revenue and profits.
I'm glad you bring up the fact that its film slate has been so successful and so consistent in hitting the mark. Chris Palmieri, one thing that you've written about is that Disney had a huge hit with Star Wars: The Force Awakens, and Rogue One this past year hasn't been as big of a hit. The company, of course, has laid out already the next, 20 Star Wars movies? Maybe I'm exaggerating, but the next 5 Star Wars movies. Can it really count on that growth there?
Well, I mean, Rogue One did $1 billion worldwide. I mean, that's still a huge hit. It's just happened to be half as well as Force Awakens. So most studios would love that kind of performance, and to have the anticipation of 4 more Star Wars doing another $1 billion, I mean, that certainly helps. It's just they're hobbled a bit by their own spectacular comparisons.
Talk about that a little bit more with the studio. What is the typical valuation that, I mean, there's other studios are much more hit-driven. They're much more inconsistent. Disney has these sort of franchises that just seem to be steady cash flows. What is the valuation that investors typically assign a studio business versus what you think perhaps investors are applying to Disney's at this point.
It's interesting. We haven't seen a lot of studios trade hands for a variety of reasons. One, they are hard to value. What tends to get valued is we've seen valuations on EBIT for something like DreamWorks and some of the other studios anywhere from 20 to 30 times EBIT, but there hasn't been a whole lot of EBIT there. So what the real value for a lot of these studios has been historically over the years is the value of their library. So when you were to step back and take a look, because that has value in perpetuity, arguably. But if you were to look at a Disney studio, A, it's got fairly consistent cash flow for a studio, and then of course B, it's got arguably one of the greatest libraries of all time. So tremendous value there, and I think most investors feel pretty good about that business relative to the peers.
Chris, how much is Disney a leader when it comes to any indication of people cutting the cord? I remember in the summer of 2015 when Disney acknowledged that ESPN was losing subscribers, media stocks had a huge meltdown. I mean, for days we saw these media companies get sold off. Is Disney the harbinger for the sector?
Yes, I think they are viewed as the most watched, and for a good reason. ESPN is the highest priced part of the cable TV bundle, and the argument has always been that live sports are the thing that everybody needs. They're the reason you can't cancel your cable. So that's why everyone focuses so much on them.
What is it going to be? What's your number one question you want to hear on the call?
I think there's going to be two. Number one is ESPN, and really talk to us about a direct-to-consumer play that this company is going to have. I think the subscriber declines are certainly a known factor. They're not going away. It's something that every cable network has to deal with, including Disney and ESPN. And ESPN has been relatively reticent to give full disclosure on what they really are thinking about doing in terms of ESPN direct-to-consumer. The second one just is timely in the last couple of days is Bob Iger. What are you going to do?
Right.
All right, great stuff. Thank you very much, Paul Sweeney, Bloomberg Intelligence Director of North American Research, and Chris Palmieri, Bloomberg News Media Reporter.
All right, coming up, we're going to go back to noted short seller Andrew Left of CITRON and discuss why he's targeting Motorola Solutions, MSI. This is Bloomberg. With Andrew Left, founder, owner, and editor of CITRON Research. He joins us by phone to elaborate on his call on Motorola Solutions. And Andrew, you say that your company, exposing the vulnerability of Motorola Solutions with a price target of $45. And you ask, what would President Trump think about U.S. law enforcement agencies paying 5 times the prices Motorola charges EU countries? So I ask you, have you gotten any kind of response from the White House or anyone in government?
I've not gotten a response from the White House. It'd be pretty neat if I did. In time, I know with the new age of communication, I'm sure this report will make the rounds to, if not the White House, Congress, at least. I mean, Congresswoman Anna Eshoo mentioned this in I think like 2 years ago. She said the days of $5,000 radios are over, and she actually discussed on record the egregious pricing of Motorola. So it's no surprise, just like the pharmaceutical industry, it's no surprise to people in the know. And now finally, once it gets out there, for people to understand, hey, maybe this franchise isn't what we think it is.
So is getting the president's attention, theoretically having him tweet about it, raise it, is it part of the short thesis? Is it part of what it would take, in your view, to get this trade to work?
Absolutely not. It works many different ways. It can work with government regulation, and that, I wouldn't say it's sweet. I would actually say to do something. Okay, I'll take it a step further. More than a tweet. Does the government just say every bid has to be a competitive bid? That's the first thing. It's going to work inevitably for a different reason. You cannot hold back technology. And currently what they're selling, these high-priced radios, are all based on LMR technologies. The new LTE, which they do not have a monopoly on, they compete in, but they have to compete against everyone else around there with much lower margins. Okay, that is the new technology worldwide. And there's no reason why law enforcement in the United States should ever use substandard equipment just because Motorola has good relationships with police chiefs.
And you said the second reason, the other reasons in which this trade works?
Well, I guess, pretty much it's technology. Technology is really the main one.
Technology is the main one.
It's going to happen. It's going to happen inevitably. But what should happen sooner than later is the government, you have the whole FirstNet program. I encourage anyone who's listening to this, who's interested in Motorola, to go to firstnet.gov. It's an emergency response system set up by the national government that they're finally rolling out in the second part of 2017. That will go ahead and pretty much overtake Motorola's franchise if it's done properly.
How much of this would happen with change at the federal government level, and how much would just have to involve changes, city by city or state by state at that level?
Okay, that's a good question. That's a very good question, because when I started looking at Motorola, the real problem is the fragmentation of the purchasing of these units. Between, in one city alone, you could have fire buying one, and police buying one, and SWAT buying one, and Homeland Security. The irony of this is while the purchasing is done locally, the funding of it is done by grants nationally through Department of Commerce or Homeland Security. So if that's just controlling the purse strings, all you would need to do is them to mandate before any new mega contracts or any new equipment is built out within the grant. I mean, Motorola actually helps the municipalities get the grants, hoping to use Motorola equipment. But the key thing is here: competition, competition.
Are there any other companies that are in a similar situation as Motorola Solutions? I mean, is this the only company that
I have not
does its
seen
business with
another
this?
company that's serving law enforcement needs that has such huge price differentiation as Motorola does between what they're selling domestically and what they're selling internationally.
You mentioned,
and I'll say this. The Motorola response was, well, these are two different radios. That would be like me telling you, obviously, I have an iPhone for AT&T or an iPhone for Verizon. Yes, the guts might be a little different, but they're pretty much the same thing, even though they're built on two different systems. And all they would have to do then is just show a cost of goods. Show me then why it costs not 5 times. It's actually as high as almost 6 to 7 times more to build a radio for the U.S., a walkie-talkie.
Very quickly, Andrew, have you heard from any MSI shareholders?
No. I mean, I think the report's comprehensive. I understand why people own the stock. As I mentioned in my report, there's one word, it's legacy. Everyone thinks that, well, Motorola has a great legacy installed base. The way I look at it is legacy is death to a technology company. I think of BlackBerry or IBM or Xerox. I want a technology company that's actually forward-thinking.
All right.
So to think that, well, they're already there in the police officer,
Andrew, we got to
go. Not
go.
going to change.
Andrew
Okay.
Left,
Bye-bye,
founder,
everyone.
owner, editor
Have a
of
great
Citron
day.
Research. Thank you so much. This is Bloomberg.
I'm Mark Crumpton. It's time now for First Word News. Alabama Senator Jeff Sessions has cleared another hurdle in the Senate to be the next U.S. Attorney General. That's after lawmakers voted 52-47 to move ahead with the nomination. Sessions is expected to be confirmed Wednesday despite Senate Democrats' opposition. They question his commitment to civil rights, opposition to immigration laws, and whether he will act independent of President Trump as the nation's chief law enforcement officer. It's the next round of the Trump administration in the fight to reinstate that controversial travel ban on 7 Muslim-majority countries. Lawyers will go before a federal appeals court in San Francisco in a few hours, trying to reverse a lower court ruling. The administration contends that last week's decision threatened national security and violated the constitutional separation of powers. The International Monetary Fund warns that Greece won't meet fiscal surplus targets set by its Eurozone creditors. The fund says the Greek budget surplus will rise to 1.5% over the long run. That's about half of the forecast from European creditors who took part in that bailout. The IMF has said it would consider making a new loan to Greece, but only if its debt reduction plans are credible. Russian athletes are set for another clash with the International Association of Athletics Federations over doping, even as the government admitted today some coaches relied on the illegal practice. The IAAF ruled Russia would not be reinstated to global athletics until at least November, extending a ban first imposed in November of 2015. The ruling could mean an official team won't represent Russia at the World Championships in August. Global news 24 hours a day, powered by more than 2,600 journalists and analysts in over 120 countries. I'm Mark Crumpton. This is Bloomberg. Joe?
All right, let's get a recap on some of the earnings that have come out after hours, starting with Gilead. You see the stock there in the middle. It's down 4% after the company missed on revenue, a little bit shy on the numbers. Let's see, what do we have here? I'm sort of lost it on my screen.
Down 4.3%
Down
4.3%
in after hours trade. EPS actually came in ahead of estimates at 2.7%. Revenue at 7.3% versus 7.16 billion for Q4, but you see the stock down 4.2%.
And just a quick mention here of Zillow as well. You saw Zillow trading lower in after-hours trade. Revenue and fourth quarter adjusted earnings per share beat analyst estimates, but for the full year revenue, $1.03 to $1.05 billion. For some investors, that doesn't seem to be enough, and you could see the stock down 5.7%. Of course, the big one that we're keeping our eye on is Disney, and this comes after the company reported a drop in revenue and in operating income because of disappointing results from ESPN. That was a bigger than expected drop, to be frank, over at ESPN. Revenue missing the consensus estimate, even as profit topped the consensus by 6 cents.
Right, and headline, all the key divisions, studios, parks, all just mostly coming in just a little bit shy of expectations, and so total revenue of $14.8 billion, about $500 million short of estimates.
And the Disney executives are reviewing those first quarter results. You can check it out on LiveGo on the Bloomberg.
What'd you miss? In less than 2 hours, a federal appeals court in San Francisco will hear oral arguments by phone on Trump's executive order on immigration. The 3-judge panel on the Ninth Circuit will hear from the states and the Justice Department. The case sets the stage for a possible Supreme Court ruling on the constitutionality of the travel ban itself and the extent of the executive branch's power in enacting such an order. The appeals court says it will likely not issue a ruling today. Bloomberg Supreme Court reporter Greg Stohr joins us now from Washington with the latest. Greg, what is the specific legal issue that is being contested here? What is it, whether the president has the right to do this? Is it the nature of how the appeal was worded? What exactly is the Ninth Circuit ruling on here?
Well, the question it has before it is actually kind of narrow. It's just whether this temporary restraining order that a judge put in place nationwide, blocking the policy, whether that can stay in effect during the rest of the legal fight. Now, the appeals court could go beyond that and actually decide whether this policy is constitutional, whether it's within the president's power under federal immigration statutes, but it doesn't have to decide that.
Greg, give us some perspective here. Is there any middle ground for the court? I mean, can it have it both ways?
There's a potential middle ground that the Justice Department suggested in its last filing yesterday. What they said was maybe what you could do, court, is if you're not going to rule all the way for us, you could modify this temporary restraining order so that it applies only to people who have previously been in the country. In other words, if you're a student and you left and you want to come back, then you wouldn't be banned from reentering. But if you're somebody who's trying to enter the U.S. for the first time from one of the 7 affected countries, then the policy would still be in effect and you would not be able to enter the U.S.
Greg, is there any way this doesn't wind up in front of the Supreme Court?
Well, it's possible because, again, if the appeals court only decides that narrow question, whether this policy can go forward, then what we might get from the Supreme Court, I mean, I think the loser will go to the Supreme Court, but the Supreme Court might just issue an order saying we agree or we don't agree with the Ninth Circuit. We're going to let this policy take effect for now or not let the policy take effect. That would, at least for now, mean we don't have a big full-blown argument over the constitutionality of it, but very likely that's coming at some point in the not-too-distant future.
So, Greg, the court said that it will probably happen this week, the decision. How will it unfold? How will we learn about it? How much context will they give us? How much detail will they give us?
Well, all those things are great questions, and I don't have answers because, the court in some ways can do whatever it wants here. I am encouraged that they have told us that it's not coming tonight, which might mean we get a little more guidance and can, plan, and maybe we'll have a little more information about what type of ruling we might get. But for now, there's a decent range of possibilities. Probably it's an opinion with some reasoning attached to it, but I don't know that for sure.
All right, thank you very much, Bloomberg Supreme Court reporter Greg Stohr. Fascinating stuff, and we'll be continuing to monitor this case. Meanwhile, what'd you miss? From politics to market uncertainty, there are reasons to be cautious about where to park your money these days and what's going in the economy. I want to bring in Bill McBride, author of finance and economics blog Calculated Risk. He's one of the few people that I follow who called both the U.S. economic downturn in 2007-2008 and the subsequent recovery. So when he sees stuff out in the markets, I pay attention. He joins us now from Irvine, California. Bill, you recently wrote a blog post called Some Random Concerns You're Seeing. You're not totally nervous yet about the economy, but things popping up there outside or out in the world that are catching your attention, making you a little bit nervous or concerned. So talk us through a couple of these things. One of them has to do with construction of high-end inventory in California.
Well, hi, Joe. Thanks for having me on. Yeah, I'm not nervous about the economy at all right now. I think we're going to be fine. But I am seeing in the coastal areas of California, there's a lot of infill where, they do demolition of the old cottages and build nice big new homes. There seems to be a real surplus of those coming in this year. There's all kinds of homes under construction everywhere I go. So, I think we need more low to middle income homes in California and probably across the country, but we're seeing a lot of high-end homes. And one of the strange things I'm seeing is a lot of houses for lease or for rent in those areas, which I haven't seen before, and that may just be a seasonal thing. It is just January, February. That's the weak part of the year.
Do you remember another time where we had a similar situation where there was so much inventory available, whether it's in rentals or new construction?
Sure, Scarlett, especially on high-end homes. Yeah, 2005. So the dynamics are very different because that was a clear bubble in 2005. This, I think, is maybe a little irrational exuberance, if you will. The builders are just everybody's excited because they've been making good money.
Another thing, and it's maybe kind of related to some of all this construction, you're talking about the impact, you've been paying attention to the impact that slowing real estate demand from Chinese buyers is having on cities. How big is this effect, and how widespread could the fallout be, in your view, if there's a meaningful pullback from demand?
Well, we've heard this before, so, that they were going to limit capital outflows. And it does seem like that it has happened in January, but once again, this is the weak time of the year. So let's give it a couple more months. I think there are areas of California that will be hit hard. San Francisco There's some communities in LA, like San Marino is a beautiful area that's heavily invested with Chinese buyers. Irvine in the area that I live, but that ripples into the neighboring communities too. You know, if there's less demand in those high-end, really nice communities, there'll be less demand in the ones next to them.
How representative is the California property market of the rest of the country, though? I mean, prices in California are in a different stratosphere given the propensity of Chinese buyers to buy houses there. They're not necessarily going to Nebraska to the same degree.
Well, you know, California is different than the country for sure. The prices are, you know, they're non-comparable except for, you know, in New York or something. But and we have a very strong economy out here, so it's a multiple factors that are making it drive up. You know, one of the things I put in that same blog post was a friend of mine is a broker for high-end airplanes, used high-end airplanes, and he's all of a sudden seen softening demand. And you know, he was asking me, well, is that from, you know, he's seeing some less foreign buying, especially Chinese. So you know, I don't know. It's just some interesting little tidbits of data.
So you're not all that worried yet. These are just a few random tidbits, the less demand for high-end airplanes, high-end real estate, perhaps some inventory building up. Real quickly, one last question. People are very excited, business leaders enthusiastic about the Trump administration. They think lower taxes, more, you know, deregulation and stuff like that. A lot of the business surveys have been shooting up. In your view, is there a direct relationship between the rise in these business surveys and the hard economic data to come?
Well, no, I think people are getting ahead of themselves. You know, everybody expects tax cuts, less regulation. There was a big hope on infrastructure. I know Goldman Sachs last year wrote, well, don't worry about immigration or trade. They won't get that until 2018. I think people are kind of changing. You know, where's the plan? We haven't seen a plan for tax cuts. We haven't seen, you know, we saw an executive order for deregulation that was really sort of meaningless. So we don't really, and there's no infrastructure proposal other than building the wall.
Right.
So you know, we need to see the plans before we can make a judgment. I don't see the plans. I don't see them coming. So I don't know.
All right, great stuff. We'll be following your blog and to see how these stories develop. Bill McBride, author of the finance and economics blog Calculated Risk. And up next, we'll hear from the women behind the Makers Conference about how they're trying to send a bold message to women everywhere. This is Bloomberg.
What'd you miss? Even though data show businesses outperform with women, we're still talking about glass ceilings. The Makers Conference that kicked off today in Rancho Palos Verdes, California, aims to shatter that challenge by providing a platform for women to talk about issues. The highlights so far, discussions by activist Gloria Steinem and actress Octavia Spencer, and a video message from Hillary Clinton. Our own Caroline Hyde was there, and she sat down with Makers founders Dylan McGee and Makers VP and creative director Samantha Leibovitz. DeCaro talked about why this year is so crucial.
It really started as an idea to just tell women's stories, and I think fast forward 5 years later, with the force of AOL behind it, it's really become a movement and a platform, and
I think a big piece of how it's evolved over the last 5 years is we need to reach women and girls everywhere. Yeah. So we went from video, we have documentaries, we executive produced our first song this year. We were about to premiere at our conference, Makers Podcast. So it's thinking of ways where we could really reach people everywhere with the message and with women's stories.
Even men. We're launching Makers Men at this conference, which we're going to premiere on Wednesday.
And is that a sort of educational piece of how they can also empower women, whether it be at school, at work, at play?
One of the things is I think you just have to celebrate the men who are putting a stake in the ground and speaking out for women's rights. And so we're trying to, because we're a storytelling platform, we're really trying to highlight the stories of those men.
We always say if you could see it, you can be it. So we want to share the stories of men who are actually doing positive things and creating change for women, because then other men will see it and get inspired to do it too.
We want men to say, oh, I want to be a Makers man. So that's the goal. We're going to have, we'll have a long line waiting.
And not only in the US, but this is getting geographical reach. How is the platform spreading into other countries?
Yeah. We launched, our first global launch was China.
It was China.
And then we did...
Interesting country to have started with.
It is interesting. It's one of the things that you want to focus on the countries that need it. And we felt like China also has the scale, and people are online.
And it was a great way. So we actually, when we went into China and then we went into Canada and the UK, we selected 10 women in each place, and we actually had on-the-ground partners so that it felt authentic. It wasn't going to feel authentic if we went in and just picked top 10 women who we thought would make sense. We wanted to have on-the-ground presence there, and then the idea of these stories are universal.
Can you give us an inkling of where you might go next?
No, that's secrets. All we're talking about is the conference and Makers Men today.
And so tell us about what you want people to take away from this conference, because there's going to be a lot of speaking, a lot of dialogue, a lot of action, though. What can people go on and take back?
We're trying to create what we're calling a bold agenda. Literally action items coming out of this conference. We're going to create an agenda. We're going to share it with not only the attendees, but everyone who joined in on the live stream, everyone who wants to join. We're going to give them concrete ways, and that's going to be everything from how do I solve equal pay to how do I change a tire. We have an amazing chicanic here with us who's going to be here helping people learn how to change oil and change tires.
That was Caroline Hyde there at the Makers Conference in California with Makers founder Dylan McGee and creative director Samantha Leibovitz DeCaro. Coming up, as Washington mulls the tax on imports, one auto industry expert says most car makers would need to raise prices by thousands of dollars. In Jaguar Land Rover's case, more than $17,000 per vehicle. This is Bloomberg. What'd you miss? A new auto industry study suggests that President Trump's potential border-adjusted tax would deliver a sharp blow to automakers like Jaguar Land Rover and Volvo, while leaving a company such as Tesla in a comparably better position. Joining us with his findings is Alan Baum. He's founder and auto analyst for Baum & Associates, who conducted this research. So, Alan, you basically engaged in a thought exercise here. Talk a little bit about your findings. Let's pick two companies. I mentioned Jaguar Land Rover. Let's also talk about Ford. How much would they have to each raise prices by to offset this potential tax? And why would there be a big difference between the two?
Well, in Ford's case, the issue is what do they bring in from outside the country that they sell in the U.S.? And the answer is small cars and mid-sized cars that have a lesser value. Whereas Jaguar Land Rover, obviously they have no production here in the U.S., are bringing in very expensive vehicles. And the issue of how much of your content is domestic has everything to do with what the cost is going to be in terms of the border tax. It's also an issue of your profits, because what we've done is we've taken two sets of assumptions. One, we've assumed that there is a change in the corporate tax structure such that companies will save money, and then we've assumed that the offset to that is this border tax. Obviously, all of that is speculation, because we don't know if those policies are going to be in place. And then the other issue is, what will the companies do? And they will make decisions based on their own profit maximization. So we might see some companies decide to eat some of the tax as a way to increase their volume, particularly when we're talking about vehicles that are very profitable, whereas in other cases they might pass along all or perhaps even more of the cost if they feel that that would be the profit maximization activity.
So obviously a large part of this idea theoretically is having companies do more manufacturing in the U.S. Do you see that happening in the event of a border tax going? Would it bring supply chains more domestic?
It's probably more likely to bring the supply chain domestic than it is the automakers. And the reason for that is there's more flexibility in the supply chain, both in terms of the number of facilities that suppliers have and the ability to invest in the capacity that they would need, et cetera. As you're well aware, it would take an automaker lots of money and lots of time to actually move assembly. And we're saying, that could be a policy, but that's going to be a longer-term policy, and it's something you really can't foresee within a 4-year presidential term. So it would obviously depend upon where the parties stacked up on this and if this looked like a long-term program.
Alan, Baum & Associates advises auto suppliers. What kind of response have you gotten to this thought exercise? What are you hearing from them?
Well, a lot of suppliers have been being asked by their customers to move production to Mexico, particularly those automakers that have set up in Mexico with the idea of exporting not just to the U.S. but around the world. And for many medium-sized suppliers, that's a heavy lift. And so, they're saying, well, should we really do that? And our advice here is, if you're thinking about that, perhaps this is a decent place to pause and to see what's going to happen, and instead continue to utilize your U.S. facilities, perhaps some investment in those facilities to increase capacity or add shifts, that kind of thing, which of course is what the automakers themselves have been doing, as, for example, in truck plants where the demand has been greater.
Tesla CEO Elon Musk is on Trump, one of the CEOs that's meeting on these Trump advisory boards. How does Tesla stand to fare in all this?
Well, Tesla's a little bit of a wild card, and the reason I say that is their supply base is a little less transparent than the more established automakers. We made an assumption. We made a series of assumptions in the study. We made an assumption that their Mexican and, for that matter, offshore supply base is relatively modest, and that's very much tied to the Gigafactory, because, of course, as the Model 3 comes online, and the volumes go up dramatically, the whole idea, of course, is that Panasonic will be producing not just cells but also packs at the Gigafactory, and that would be U.S. content. And, of course, the battery is a significant amount of the the input. So they would be relatively modestly affected. We know they get some componentry from Mexico. We just think it's rather modest.
All right, Alan Baum, auto analyst for Baum and Associates. Thank you so much for joining us.
Thanks for having me.
And to check again on the shares of Disney, they are falling in late U.S. trading as the company missed on revenue estimates. We're getting more details from the results on the company's conference call. CEO Bob Iger saying he will stay as CEO if it's for the good of the company. You can listen to the call on the Bloomberg at LiveGo. For more details, watch Bloomberg Technology at the top of the hour. This is Bloomberg.
Half a billion smartphones in India turning into shopping carts. Some see disruption to retail. We see e-commerce multiplying, seeing what others have seen, but uncovering what others have not. That's the power of global connections. Bank of America Merrill Lynch.
Finding a relationship can be like finding a needle in a haystack. With Elite Singles, you can be sure to meet university-educated professionals, all looking for serious relationships. Ditch the haystack. Register today at EliteSingles.com.
Direction is the single most important thing investors need to know to make money in the market. When the stock market skyrocketed after the election, VectorVest nailed the bottom. On November 4th, we told investors the market could rally explosively. On the 11th, we advised bargain hunting and bottom fishing and then gave a confirmed up on November 15th. How's that for clear direction? Test drive VectorVest for yourself. 5 weeks, risk-free, under $10. VectorVest.com. Before you invest, check VectorVest.
Home Advisor is a very easy way to find a home contractor, and for me, it's the only way.
Home Advisor instantly connects you with top-rated pros for any type of home project.
If you need it, Home Advisor has it.
And it's completely free. Go to HomeAdvisor.com now.
People turning homes into hotels. Some see an industry contracting. We see opportunities expanding. Seeing what others have seen, but uncovering what others have not. That's the power of global connections. Bank of America Merrill Lynch.
Put your nest egg in analysis? No, not this. This. PersonalCapital.com, the free website that makes it easy to manage your finances and grow your net worth. Join for free. Take our free investment checkup. Use our fee analyzer to uncover hidden fees that could be draining your assets. You'll see all your accounts in one place and get all these free tools, including a retirement planner that takes the guesswork out of retirement. Join for free at PersonalCapital.com.
For fast relief from sinus and allergy symptoms without drugs, get Navage.
This time of year I get so stuffed up, but Navage flushes my sinuses so I can breathe again.
Navage uses gentle suction to remove allergens, germs, and pollutants. It's the only nasal irrigator with suction.
My doctor recommends Navage to breathe better through my nose, and it works. Congestion's gone, and I feel great.
And Navage is so much easier than a neti pot.
To breathe better without drugs and a 30-day risk-free trial, go to Navage.com now.
Disconcerting too. Are they losing these subscribers because to ESPN and so on from cord cutting? Is that the reason for the loss? Because that would be really disconcerting, because it seems like a trend and not just a one-time thing.
Yeah, it really does. And they kind of highlighted this trend back in the summer of 2015, and that really spooked the media stocks in general and Disney in particular. So we do know that cord cutting is occurring. All the cable networks are experiencing about a 1% to 2% decline in their subscribers every year, including ESPN. So that's a fundamental issue that all the cable networks have to deal with. The question is, do they get some of those subscribers back in some of these skinny bundles, or maybe going by direct to the consumer with a OTT service like HBO Now? So are they going to get some of those subscribers back that are leaving the big bundle? That is a little bit uncertain right now. So I think investors are pretty sensitive to those subscriber numbers and to the revenue numbers coming out of the cable networks.
We've got some sound from Bob Iger on the call. Check out what Iger had to say, and I'll get your reaction after we hear that.
I've been with this company for 43 years, and I've actually been CEO for almost a dozen years. And I'm going to do what's in the best interest of this company, which is something the board's clearly going to help determine. And while I'm confident that my successor is going to be chosen on a timely basis and chosen well, if it's in the best interest of the company for me to extend my term, I'm open to that.
Well, listen, I just jumped off that earnings call myself to come on here, and I can tell you, I'm probably speaking for most people on that call when they would say, Bob Iger can stay as CEO as long as he wants. So I suspect that he will stay until the board really finds somebody either